They're just done. They're done being. We had 6, depressing weeks.
Yep.
Nothing is new. I mean, sure, China's. I guess we got decent data from China. Futures were up this morning. Okay, fine. But who believes China? I'm not sure anybody. Greece is still going to default.
Yep, that's right.
So here we are. Best Buy, I guess, had good numbers. Retail sales were pathetic, but not as pathetic as expected.
Take away food and energy, they're actually up 0.2%.
Because nobody needs food or energy, so why not take them out?
Why not?
So where are we?
Things are looking good today. Look, today, this is where it is. Okay, you're 3 weeks removed from, or 3 weeks away from the end of QE2.
Right.
So the question will be, what's going to happen next? Now, look, the data, the macroeconomic data has been poor. I mean, we've been talking about this for weeks. It's been showing in the stock market 6 weeks of a straight sell-off is not a good story at all for the markets. But going forward, the question will be, what will the Fed do? And we're just relying on the Fed. Don't forget, there's a heavy economic week. You have a number of economic data points coming out. Inflation, obviously, the retail sales number, consumer sentiment on Friday. A lot of things that can influence the market and will move the market. This is great, but I would expect a lot more volatility as the week progresses.
Now, it's interesting you say that because there was a trader on this morning, and he said he'd be shorting this market right now.
Yeah.
In the anticipation that it's going to come back down.
Look, the fundamentals are this. Stocks are going to continue to rally and move higher only because of earnings. If you are a fundamental analyst right now, when you have a 6-week sell-off, that should have been a great opportunity to buy in because realistically, you still have stocks that are doing great on the bottom line. It's at the expense of human capital. You have companies that have a ton of cash on hand. They're not hiring anybody. They're stretching their labor forces as thin as they can do it, and they're increasing productivity as a result. But when you look at all of the numbers, just on the earnings, that should move stocks. The problem is traders on the floor of the exchange, they're looking at everything, and they should, but they're really focusing on what's going to happen with a QE3 or 2.5, or as you say, QE and drag, or
QE3 and drag. But here's the thing, to your point, the bifurcation between Wall Street and the Main Street economy is going to continue to spread, and I will argue more and more and more, because to your point, stocks will continue to go up at the expense of human capital. No one is going to make any kind of effort to hire anybody these days. We're not seeing that whatsoever. But you get QE3 in drag back in this market. All that does is help the stock market. It doesn't help us.
$5 to $7 billion a day in liquidity injections. That's what QE2 is doing right now. So when you have around 2 o'clock today, you will have the Fed come in, most likely because you have an update right now. We're up 130. You'll probably see anywhere between $1.8 and $2 billion in liquidity injections today. If we're down tomorrow, don't be surprised if you see that $5 to $7 billion injection. And remember, this is a Fed that still has $50 billion to throw into the market in liquidity injections before the end of the month. You can't tell me the market's going to. If the market slides any further from here on out, then there clearly is a damage pattern that we have to be worried about in July.
So what's really interesting then is if you go with that theory, you're a fool not to be in this market right now.
Oh, yeah. Well, where else are you going to put your money? I mean,
there's that.
0% interest. You can't earn anything. I mean, you could get ING and get 1% maybe. But other than that, if you want something with stocks, you're looking for dividends, anything with the multinational flavor, you definitely want to look at large cap stocks.
Because it's fabricated.
Yeah,
it's completely fabricated.
It's false. Let me tell you something. It's false wealth that has been created. If you look at just when Chairman Bernanke hinted at a QE2 at the end of August of last year, stocks have gone up in that pattern, just thinking that we were going to have this major liquidity injection. We didn't even know how much it was going to be. And then they released a number of $600 billion, and stocks obviously have been on a tear since. The issue with QE2 was to increase your sentiment, your personal confidence. Therefore, you go out and spend money. I mean, you saw it on Black Friday after Thanksgiving. People were selling the sofa to go and hang out all day at the Walmart to go and buy stuff when they really shouldn't. They could never have afforded it, but they still went out and bought it, and that helped stocks, and it has helped stocks progress. Problem is what's going to happen in the second half of this year.